So we're here at the Silver Summit 2014 at the Davenport Hotel in beautiful Spokane, Washington, and I'm very happy and very excited again to be with Mr. John Kaiser of the bottomfishreport.com. We saw his presentation yesterday, very, very interesting, and thank you John for being on the segment today.
Thank you for having this interview.
Excellent. Okay, so let's start out. You know, a lot of people reference your work in terms of the survivability of junior mining companies. You know, every year more companies going bankrupt, the negative working capital. You know, you mentioned on your presentation 700 companies were cash strapped. So where are we now? How do we go forward in terms of how many more juniors are going to go bankrupt? And is there any M&A activity to kind of help these guys out?
Well, through Kaiser Research Online, we track all the information related to publicly listed Canadian resource sector companies, and the situation in the last few years has deteriorated substantially. Funding activity, especially for resource sector companies, has subsided, and this basically started in 2011, which was the end of the post-2008 crash rebound. And now we have, out of the 1,700 companies that we track, 700 have negative working capital, totaling $2.5 billion. This is money that's never going to be paid back. About 1.4 billion of that is in companies trading below a dime.
Right.
These companies are managing to hang on, but they are in effect zombie companies. Nobody's going to give them real money to repay. More interesting are the 300 or so companies that have between like next to nothing and $500,000, and there's a lot of good, interesting companies in that group that would be ashamed to see have to fold and disappear. And then there's about 600 companies that have between $500,000 and $20 million, and that's the group which is probably going to survive. I think we will see going forward a substantial shrinkage in the number of companies that are recognized as legitimate exploration teams. And that's a good thing, because the TSX venture has polluted its brand by allowing way too many frivolous companies to get listed. These capital pools, they auction some meaningless property. There's no serious target in these things. And the public audience, it just ends up not being able to focus. There's too much distraction there. So, well, it's interesting that you bring up the Fruta del Norte deposit that Aurelian found, and that was one of the perhaps the biggest exploration success by a junior in the past decade. Kinross paid $1 billion for it, and then because of resource nationalistic tax changes by Ecuador, basically had to shut down any further advancement. So now the Lundin family, through their shell Fortress Minerals, which had about $20 million in it, as left over from a previous foray into Russia or somewhere like that, they're now buying this asset for $250 million. Now it's interesting because in this last decade, the majors bought out $140 billion worth of juniors, and that was fabulous. This has never ever happened. A lot of it involved existing deposits that have been found in past exploration cycles, but just didn't have the grade needed to go into production back then. But when we had all these substantial real metal prices gains in the last decade, these suddenly became interesting. There are companies still out there that hold these assets, but because we've had substantial mining sector cost escalation in the last 5 years, while at the same time prices have pulled back from their peaks and general economic conditions are not promising for seeing a substantial demand growth, we're heading into a period of flattish prices. There are companies there that will be picked off by the majors, but it's going to be kind of a disappointment. We would like to treat them as options on higher metal prices, but I think the majors will clean them up at modest markups from rock bottom prices. And they're sitting on all this inventory. If prices do go back up in several years and we get a bull cycle, this business of pulling old deposits out of the woodwork and demonstrating the feasibility, the majors aren't going to have an appetite for it. They're already sitting on enormous inventory. Some of it will be spun back out into the juniors, such as we're now seeing with the Fruta del Norte, and that'll create some action for at least the institutional audience, which will come back when we're in a stronger metal price scenario. But it's going to have to lie with the exploration companies companies to breathe life back into this sector.
And it's very interesting you bring up that point, because that leads to my next question here, is the rate of new discoveries. There's not as many new quality discoveries out there, and given the gold price right now, you had a really good example of the Eleanor gold deposit and IRR on that. Can you just expand on that and what we're facing now and how important the role of new discoveries are?
Well, when gold went up to $800 in 1980 and crashed back to $400, that was a 400% real price gain. If you inflation adjust that to the present, that's $1,120. At $1,200 something, that's only an 8% real gain. And there was an awful lot of gold that became low-hanging fruit harvested in the last 30 years.
Right.
2.3 billion ounces. So the explorationists, the Canadian amongst them, amongst the top, along with the Australians, have done a fabulous job scouring the world, and especially when the Iron Curtain came down and South America and that opened up.
Right.
So what you can find on surface has been looked at, drilled and all that. So we have a number of things. One, we have the much higher costs, the capex explosion. The Eleanor deposit is an example of that. The best Canadian discovery in the past decade, bought out by Goldcorp for $750 million. Now it went into production for $1.8 billion, cranking out 400,000 ounces a year, and it's a medium-grade deposit, 7 to 9 grams per ton, but its after-tax IRR is about 3% at $1,300 gold. It's going to take 8 of its 10-year mine life for payback, and the net present value is next to nothing. So the higher costs have really raised the bar as to what counts as a big discovery. And if there's going to be more discoveries, it's going to require innovation. Companies with creative models, new geological models, looking undercover with new techniques to see buried blind deposits. That's where the trend is going to be. Unfortunately, that's very expensive, and as we mentioned earlier, there's no risk capital coming into this sector. So how do we get out of this catch-22 where we need a fabulous new world-class discovery to reinvigorate the investors and make them believe that yes, the juniors can produce results that make stocks go up not just 10 times, but 100 times in price.
We've been dropping the indexes so far. The TSX 1,800 points, the Dow Jones 1,350, the T6V 240 points, even international exchanges. So where do we go from here? How do we get back to those levels that we experienced earlier this year?
Well, in the case of the Canadian exchanges, they are very resource-based, both energy and minerals. And so with the end of the whole super cycle talk and a pretty good mine supply response, which has put the markets back in balance. In some cases like copper, it's going to be in oversupply for a while. That has taken the air out of these stocks. They're down substantially. Gold's retreat from 1900 back to the current levels, combined with all the catch-up in costs, that has made these sectors, nobody wants to be in there. The other question you're alluding to is, well, what about the big equity markets, the US, the Dow Jones, the S&P? And they have done tremendously. And right now we're at a very scary pivot point, because most of that has been accomplished through the monetary response that was almost exclusively used in the United States to deal with the financial meltdown. Through quantitative easing, they have injected $2 trillion into the market by buying T-bills and government bonds, and this capital has flowed back into the stock market and pushed it way up. But now that the QE is being withdrawn, there is an expectation that interest rates will gradually rise, and so the concern is the timing right for this? If it's wrong, and we get a correction of more than 10-15%, we get another financial meltdown, then I think the world is down for the count. Then we head into a depression. On the other hand, there is $10 trillion parked in bank deposits in American households that's earning next to nothing, and the people are keeping it there. They're not spending it because they don't see a future. They see this artificial stimulus that is now being withdrawn. They're not sure the patient can get off the bed and start walking again. If the patient does start walking again, business, which is sitting also on $2 trillion, has been using it just to buy back the shares, they're going to say, okay, we are going to do capital investment. America has a future again. The economy is going to grow. We're going to create real jobs. And then the banks will start lending again to people because say, yes, there is going to be job security. So we go back to organic growth rather than this synthetic growth that we've had. But right now, we don't know which way this is going to pivot. It is a frightening time right now.
And it's very much needed. I mean, not to say that the U.S. is the only one that's doing QE. I mean, you're seeing countries in the world, China's pumping money into the banking system as well. So it's not exclusively the U.S. only. But then again, the U.S. is taking a very large portion of the QE when you compare it. So.
And one of the negative things of this is that as America becomes the first to withdraw QE, the capital that has fled abroad into the emerging markets is now abandoning the emerging markets and returning to the United States, which is of course another negative for our resource sector because it is the higher growth levels of the emerging economies which are the primary engine for metals or materials that demand growth.
Get a hold of you on KaiserBottom-Fish.com, is that correct?
You go to Kaiser Research.com. And if you're interested in the scanning, there is a link called Scanning Resource Center. Also, if you want to see the statistics about the health of the resource sector, go click on the Junior Crisis Resource Center link and you'll get all the graphics and numbers that show you what's going on out there in the sector.
Excellent. Well, if you want to get a hold of John Kaiser, as you mentioned, visit his site. Thanks. We're at the Silver Summit 2014, and thanks so much, John. Appreciate it.
Thanks, Sonny.